Hello, I'm Steve Ballinger. I'm the creator and instructor for the course and a long-term successful investor. And this is a full and complete course that will teach you everything you need to know to be successful when investing in stocks and the stock market. You see, investing can seem very complex, and frankly, there is a lot to learn. But at the end of the course, you will know all the strategies, tactics, and steps to take so that you can be successful investing in stocks and the stock market. I know when I look at courses, I look at three main things. Has the instructor done this before? Can they teach it? And what is included in the course? What type of value am I getting for my investment of time and money? So let's take a moment to look at those three things. Okay, so this is the hardest part for me, as in my culture, you do not share your financials, but it's important when considering a class, particularly with investing. So here's a snapshot from a couple investment holdings I have, and about 80% of that is stock investments, at least at this time. Also, I have tens of thousands of students enrolled in my courses, and here's a note from Udemy actually asking me to teach more courses, so I hope that helps in terms of me living the life and being able to share key best practices with you. But what really matters is what you will learn, and this is a complete flagship course with over 10 hours of video and growing. And it's perfect if you are new to investing in stocks or want to improve your results. In this complete course, some of the items you will learn about include: can you make money in stocks and how much? Are stocks risky? And how to determine which stocks are more risky than others? How to evaluate and pick stocks? No calculations are required for things like ratios, as I show you where to find all the information. How to use free tools such as stock screeners when picking stocks. Looking at individual stocks, stock mutual funds, and exchange traded funds, and the advantages and disadvantages of each. I walk you through complete demos as I evaluate stocks in various categories such as value stocks, growth stocks, and dividend paying stocks, and what to look for and what to watch out for. Even the mechanics of how to actually place a stock order, and special situations such as initial public offerings or IPOs, stock splits, stock buybacks, and more that you can take advantage of, plus a whole lot more in the course. So the course covers a ton of material so you can be more confident and successful. And best of all, Udemy gives you a 30-day money-back guarantee, which is terrific because I want you to love the course. And if you don't, it's easy to get your money back. So you really have nothing to lose and everything to gain by being a master at investing in stocks, which will help fund your goals and your future dreams. So the next step is simply to click the button to get started. Many thanks for your interest in the course once again, and I look forward to seeing you in your first lesson. Hello and welcome to the course. I'm so glad you're with us. Hi, I'm Steve Ballinger. I'm the creator and the instructor for the course and a long-time successful investor, and I'm very glad you're with us here. As you can see, it's a very big course. We've got a lot of material to cover, which hopefully that's great for you. And the course is designed that you can start at the beginning and go all the way straight through, and it's in a logical manner, so you can do it that way. Or if you are, depending where in your investment journey, maybe you want to skip around to different sections or different lessons, that's perfectly okay. It works that way as well. Whatever works best for you. Though I would encourage you to watch the next two lessons first. They're kind of good foundational ones around can I make this money in the stock market and how much, and then also looking at, well, what's the worst that could happen and what's a worst case scenario. So the two lessons that happen after this one are good foundational ones to watch, and maybe the whole purpose, they'll get you all excited about investing in the stock market. A couple other things to make sure how you can consume the course as best as possible for you in this quick introduction. One is you can change the speed. Udemy allows you to change the speed. They change your look every once in a while, but they'll always have a control as far as how to adjust the speed. So sometimes I get very excited talking about stocks, and I might talk a little fast for many of you. Feel free to slow it down, to change the speed down if you need to do that. Also, the video quality comes out automatically based on your internet connection and other things, your device, and Udemy takes care of that all automatically. But everything I filmed is in 1080p high definition video, so you can always adjust that as well. If you want, just Udemy automatically streams it to be at the best rate. Also, a couple things. Good to take notes. I would encourage you to take notes as you go through the course. Maybe you hear something, you're like, oh, I heard about this mutual fund expense ratio being about 1%. Might want to look at that. And maybe you're thinking, I have mutual funds. Maybe I want to check that. You just make a little note as far as some things you might want to check, or maybe you want to look at a link or something that's included in the course later. You can do that. So it's good to take notes as you go through the course. And lastly, ask questions. That's a beautiful thing about Udemy, is you can ask questions, and I answer every single question. And I encourage folks to ask questions. I encourage everyone in the course to jump in and answer questions and share their thoughts as well too. So click the button that says Q&A or questions at the top there, and feel free to ask questions. Once again, I answer every single one. Okay, well that's it for this short intro. Let's get diving into the course now and learn how we can become great at investing in stocks in the stock market and make some good money along the way to fund our goals and dreams. Well, if I was taking a course on stock investing, probably the first question I would have is, hey, can I make money in stocks? And if so, how much? That would be pretty important to me, and I'm sure it is to you. And the good news is, yes, you can make money in stocks. In fact, stocks outperform things like bonds and cash and other asset categories, so they're a great way to grow your money. I suppose this is a pretty short and lousy class where you said, well, no, you can't. Since it's a good long course, yes, the good news is that you can. The key is historically you can make stocks. That doesn't necessarily mean you can in the future, or the past predicts the future, but we have over 100 years of information. So yeah, stocks can make money in the future here, I believe. Certainly over the long term, stocks make money. In the short term, they can be really risky or volatile, go up and down quickly, but over the long term, they do make money. And I'll show you some charts and things in a second here, and that shows that. And they do tend to go up once again over the long term. Individual stocks might go down and never recover, certainly, but if you have a diversified portfolio of stocks and apply some of the principles you're going to learn in the course here, you're going to be in a much better place than somebody who's just buying stocks without really much education. So historically they go up, there's a long-term investment, and they tend to go up over that long term. So how much? Let's take a look at some charts and some numbers so you get a feel for how the stock market kind of works as far as returns. This chart here just shows some historic market returns. Looking at the Dow Jones, it's a smaller basket of stocks, only 30 of the largest U.S. company stocks that are representative of a variety of industries. Been around since 1896, and I wanted to use this, though it's not truly representative, it really does follow the rest of the larger type of stock market generally. And as you can see over this chart, if you start over in the 1900s, stocks go up, and over the long term, as we get into today, you can see that stocks have gone up by following the upward motion of that chart the whole time. That's the good news. Now the challenging news. You can see there's some drop-offs in there, as it's not just a straight line going up. There are up and downs, peaks and valleys, and when it's going down, that means your investments, your stock has gone down. Maybe that's a great time to buy some new stocks, actually, as you're buying low with the idea of eventually selling high, right? Stock investing 101. If you look at here, like look at the end of 1929 here, right at the beginning of 1930, what happened then? All of a sudden stocks went plummeting. Well, that was the Great Depression, right? That was the Great Depression of the 30s, and you can see how the Great Depression stocks went down pretty quickly, very quickly. But they rebounded, and they overcame the Great Depression. They overcame World War II in the 40s, and they overcame all these things, are these obstacles to stocks and the world and challenges overall, and have continued to rise over a long period of time, outperforming things like bonds and cash and their peers. So long-term investment, it can be really, really good as far as investing in stocks. If we wanted to see how much return that would be, looking at this chart here, I pulled this out of Vanguard. Vanguard has some sample portfolio, so they did a more broader based look at stocks from a larger amount of stocks than just the Dow Jones, so they can give you a feel for average annual return over a long period of time. This is looking from 1926, right before the beginning of the Great Depression, happening in October 1929, all the way up to at least 2015. Not too far in the rear view mirror here for us. And this is a portfolio of 100% stocks, broad base of stocks. And you can see the average annual return is 10.1%. So somebody says, oh, the average return in stocks is 10%. That's kind of where they're getting that number from. It's not totally the total story on that, but it's at least a starting point number to say, yeah, it's not like 1 or 2%, or it's not keeping up with inflation. It well is. So you're looking at 10%, but that could be, it's been less in recent years, maybe more in other years. And you can see the range, the best year and the worst year. Best year overall stocks up 54%. Wow, hooray. Worst year down 43%. Oh my God, that's not fun at all, right? So you can see that broad range. And the interesting thing with that broad range, that's right in the middle of the 30s, right? You got the Great Depression, and stocks went way down, and then they went way back up, and they went down, and all that. You can see that was a very volatile time, and we got some volatility now, but not like that. Years with a loss. So this is saying that out of 90 years of investing in stocks over this 1926 to 2015 time period, 25 of those years you're going to have a loss. It might be only 1 or 2%. It might be as big as 40%. But 25 of the 90 times you're going to have a loss. The good news is the other 65 times, you've got a gain. or at least breaking even. You've got a gain, you don't have a loss. And so that's some good news as far as investing in stocks. If we looked at it by another chart here, just to give you a feel for it and get you comfortable with it, if we looked at stock market historical returns by decade, you can kind of see where they're at as far as that too. And you can see some of these early numbers here. You know, they got the 10s, 1910s, 1920s, 1930s, all that. Even the 30s with the Great Depression, you can see at the end, if you start at the beginning and then at the end, you lost like 0.63. Yeah, it was 10 years of misery, but it wasn't like you were down 40% for a whole decade. And if you kept investing, you were buying low actually during that period. Then most recent times, you can see we have the 1980s and certainly the 1990s with the internet boom and bust. So you had that. You had the 2000s where it was pretty flat. That was kind of considered, you know, kind of a flat time period. This is once again looking at overall stocks, more U.S.-based stocks for this number. You know, so overall, but worldwide we'll file a little bit too. But just to give you a feel. And then more recent times, some better returns, but that can be up and down too as well. It's very, very recent type numbers. So the thing to take from this is that, yeah, there's going to be up times and there's going to be down times, but overall there's some up times. And particularly if you continue to invest and continue to take a portion of your income and invest it regularly in the stock market, you're going to do very, very well. In a broad diversification thing, you know, I certainly advocate investing in things like bonds and a little bit in cash possibly, you know, depends on your investing goals and all that, but you can see some returns here. Let's finish this lesson here with one other thing. We're going to do a demonstration here, and we're going to look at one other thing here as far as, well, what if I continually to invest in stocks, and how does my money grow over time? I mean, I'm taking on some risk. Yeah, the returns look pretty good. What will it look like in the future for me? So let's do a demonstration of that. And really where you go is you go to MoneyChimp, you go to moneychimp.com, go to Compound Interest Calculator, and you will find it. So let's go take a look at that and do some demonstrations. Okay, we're here in moneychimp.com. I think that's kind of a fun name, right? Moneychimp.com. You can see in the upper right. We're in the compound interest calculator. If you just go into their calculators or calculator / compound interest, you'll find it. It's a very simple calculator to show how your money grows over time. And we'll do a demonstration here with this, and you can go to this and play with it yourself and put in your own numbers based on maybe how much you have to invest at in a particular time and how much returns and things you might expect. So let's say we start with 0, or we're going to walk through this different calculator, and it's going to tell us at the end what is our future value, what are we going to end up with after a certain time period. So let's walk through this real quick here. So let's say my current principal or money that I have right now is 0. I don't have anything invested at all. I have 0. And let's say that every year, annual addition, you know, let's pick a number here. I'll use US dollars. I'm from US, so, you know, bear with me. You could use rupees. You could use pounds, you could use euros, whatever your currency might be, but let's say we'll use dollars in this case. And let's say every year, let's say I'm doing well and I contribute $10,000 a year. You know, maybe it's less than that. Let's say I'm just doing let's do a little less. Let's say $6,000 a year savings and investing in the stock market, all right? Once again, you adjust it a little higher, a little lower, whatever you want to do. And let's say we do this over 30 years, right? So if I start at 25, let's say that would put me at 55 years old. Not even 40 years, that might get me closer to a traditional retirement age. And as we saw in stocks that we could get, you know, around a 10% return on a rate, maybe a little bit lower. Certainly we don't know what the near-term future is, so let's go real low. Let's say, you know, we could get 7% on our stocks. We're not going to say 10 or 9. Let's be pretty conservative on it. And if we have an overall diversified portfolio of stocks and bonds and cash, we might even put a little bit lower number on that. But let's start with 7 just to see what it is. Make additions at the end of each period. So that means at the end of every year, you'd add $6,000. You could be, you know, investing every month too as well. That's actually a better strategy. But for the purposes of the calculation, here's our numbers. We start with nothing. We're investing $6,000 a year over 30 years, 7% annual return. Let's see what our number ends up at the end by investing if we can get a 7% return on our stock market portfolio. And you can see we're at $566,000. So, you know, just by investing that every year and how it grows and compounds, we're over $500,000. If we let that grow to maybe a more full retirement age, let's say 40 years, and as we got promoted and did things at work or in our careers and we were able to put away a little bit more, maybe we were able to do $9,000, still 7% interest, how would we do then? Wow, that's like $1.7 million. You know, that's pretty good over a 40-year period. I mean, so you can see how stocks and things grow. Let's go back down to our 6,000 just over a longer period. And you can see even with 6,000 a year over a long period, 40 years, it'll grow and you're over almost $1.2 million. And if you're closer to your retirement age or you're closer to things, just adjust these numbers down. Maybe you need to put in a little bit more and take out less years to grow. The point of all this is that by investing in an asset class like stocks, which will be riskier but outgrow the market, you can see you can get some pretty good returns here over time, and that's what helps fund your future goals and your future dreams. So can you make money in the stock market? Yes. Now, is it risky? Yeah, and that's what we're going to talk about in the next lesson here, and we're going to look at the worst case scenario, and I think that'd be pretty interesting. Well, what's the worst that could happen? And that's coming up next. Okay, so a big question is, how much should I have in stocks as far as where I'm at in my life in relation to my goals? And is there some kind of, guidance around that? And there is. If you search like portfolios or stock and bond portfolios or portfolio allocation on the internet, you'll get a lot of different sites and things giving you maybe different information around how to build a portfolio. I'm going to share one with you here because I think it's really good and gives you some actual numbers versus just guessing or theory or saying you're a modern investor, so you should be 50% stocks, 50% bonds. It actually gives you some historical data too, and it happens to be from Vanguard. So here's the link is on the slide. But if you're looking to go to it, basically search Vanguard. And under model portfolio allocations or model portfolio, if you put Vanguard model portfolio, you'll find it pretty easy. But you can see the link up the top here too on the screen when we take a look at that. So basically what Vanguard is going to show you is it's going to look at some average annual returns. It's going to show the best year, the worst year, and the number of years with a loss. And you get a feel for how much is these different asset classes in there. So let's take a look at that, and you can kind of maybe start figuring out, well, where might I fall when I'm investing in stocks and other investments in far as these different types of portfolios? Okay, here we are with some sample portfolio allocation models. This is from Vanguard. You can see the link at the top here. Basically, if you just search Vanguard model portfolio or model portfolio allocations, and with Vanguard in the name, you're going to find it. Otherwise, here's the link. You can certainly look at that and grab that. So basically, these are model portfolios. And they'll get an idea of different risks and things as you go through here, but you can see it's looking at stocks and bonds, and then like the green would be like some short-term cash or things like that, looking over a long period of time. So if we look at, let's say, the first one, which is 100% bonds, that means there's no stocks in there at all. You can see a return of like 5.4%, and the best year was in 1982, 32% on bonds. Wow, that was something. And then the worst year, 1969, down 8.1%. And then years with a loss, as we go through, you'll see how this changes. 14 years there was a loss. If you had a portfolio where you only invested in bonds, you didn't invest in stocks at all or any other instrument, just in bonds. And then Vanguard breaks this down by different categories. This happens to be the income category. As we go forward, you'll see some moderate and growth in different types of categories. So in this income category, as you can see, they've got bonds, but then they have like 20% stocks, 80% bonds, 30% stocks, 70% bonds, so some ideas of different things. If you're really looking for income, regular income coming in on a quarterly basis, and you're really looking for income, less about growth because there's very few stocks in there, 20 or 30%, and more about income. And you can see as you add stocks, the returns go up. You get the 6.7, 7.2, because over time, stocks will outperform bonds over a long period of time, and this is over a long period of time. And you can see the years with a loss because it's riskier. Here at 20% stocks, 80% bonds, you have 12 years with a loss. Actually, versus 14, this is a unique thing where by adding stocks and adding various investments, it actually reduces risk. It is kind of a funny thing. So if you look at this, and this is true, this has been studied quite a lot, and you can see the best years and the worst years. You can see there's more volatility, bigger ranges, those kind of things. But if you look at it, you'd say to yourself, wow, I could get a better return over time. This is all past performance, and I don't guarantee a future performance. But over time, if I invest 30% in stocks and 70% bonds, well, I can get a better return and still have the same downside as far as years with a loss if I was 100% bonds. In fact, I'd be even better with years with a loss with 20% stocks and 80% bonds. So if you're an income investor looking at this, you might say, hey, I might want to add some safe dividend stocks. They'll pay me regular income. I need the income, but maybe I'll get a little growth, and actually it helps reduce my risk as well. So this is the income category. This would be good if you're already retired or very close to retirement, or where you're not looking for growth over a long period of time, and really to kind of set it up. Now, let's say if you want a more of a balanced type fund where you're trying to reduce volatility, that means you're reducing risk. You're reducing how much it goes up and how much it goes down. You're trying to limit those short-term fluctuations, as it says here, and it's thinking about more mid to long-range investment time horizon. So it's not super long time horizon, but more of a mid. This is also good if you're looking for something a little bit less risky and less volatile. And you can see here, they have different mixtures again, 40% stocks, 60% bonds, as you keep going through here, 50-50 and 60-40. And you can see how your returns start going up too. The more you add stocks, the more your returns go up. You can see these best years, worst years. You can see how your best year, when you get to 60% stocks, 40% bonds, pretty high, 36% in 1 year. And the worst year was down 26. Now this is old, this is back in the 30s. So this was when it was very volatile. You were looking, right at the right after the Roaring 20s and Great Depression time. So understand that, and you want to look at a more recent number, but it gives you an idea of how volatile it is. Also, it gives you an idea. I like this years with a loss because you get a feel for, if I'm a risk-adverse investor, well, I might like this because I got more stock, but I'm only going to go down 16 out of 90 periods, 90 years, versus going up here where I'm up to 21 now out of 90, and I'm eking out a little bit more return, but I'm going to have more risk as well if I'm 60-40. But this is kind of considered balance. As far as like more of a balanced type approach. Maybe you're getting closer to these mid or even a long-term investment, but maybe you want to be more risk averse with your long-term investment, or you want something more balanced, or maybe you're getting closer to something like financial independence or retirement, and you want to start mixing in things like bonds and stuff to help reduce that rate, that possibility of going down in those big losses. As we go to growth here, sample portfolios, once again, 70% stocks, 30% bonds, 80-20, 100% stocks. You see a lot of people with who are younger or have a long time horizon, especially going to the 80-20, maybe 70-30 to reduce it a little bit in terms of risk. But if you got a long-term time horizon, you don't mind short-term fluctuations, and especially if you're okay with big fluctuations, then you might want to go 80-20 or 70-30. And you can see, at 70-30 now I'm at a 9.1, and then I go to 9.5. At least historically, this is not necessarily what's going to happen the next year or two, but historically, and you can see these best and worst years with that. And then years with a loss, 22 and 23 as far as years with a loss. So that means out of 90 years, 22 of those times I'm going to have a loss, even with those mixes, or 23 times, and I'm able to get out better performance. Now you might have 3 years in a row with a loss, and they might be significant big losses. And you have to understand your time horizon, and can you withstand that when you're building your portfolio as far as the mix of stocks and let's say bonds. If you're looking at this and saying to yourself, well, if stocks are so good, especially if I have a long time horizon, I'm in my 20s or whatever, I'm like, let her ride, let her roll. Let's go 100% stocks. Hey, you could do that. You could go 100% stocks. You can maybe get some big average annual returns. You can see the fluctuations are pretty wide. I could be up 54% one year, down 41%, down 43% the next year. This is good questions when you look at these growth type portfolios. If you're down 30% or 20% in a year, what are you going to do? Are you going to hold on, which is good, and maybe buy more? That's what you should do if you're in this growth thing. If you sell, then you're buying high and selling low, which is the exact opposite of what we want to do. So if that is scary for you, then you might want to go back up into those more balanced type things, even if you have a long time horizon. But if you want to get better returns, at least proven over time, and have a little bit more risk tolerance, you can take on more risk, then more stocks for the long term is a good way to go. You start getting 100% though, that gets a lot scary for a lot of folks. But I see a lot of people in the growth phase. Certainly for myself, I've been always running like 80-20 for a long period of time. Even now, as I'm an older guy, I'm still more the 80-20, 70, between 75 and 80, and I'm getting closer to some of these goals, of course, just because I have that higher risk tolerance. I'm used to it over the years. So in the bottom here, they give it a description of how the methodology they use. They're basically using indexes, looking at wide indexes, so they're not looking at individual stocks or anything. They're trying to give you a feel by using wide indexes. So it's a nicer methodology. Nothing's perfect, but it's a nice methodology. So if we scroll back up here, a good way to start with this is say, where am I at in terms of my goal? How far away am I? What's my risk tolerance? What's my need? Do I need income or do I need growth? And then find out what big bucket you're in. If I need income because I'm in retirement or very close to it, well, this is maybe what I'm looking at. Maybe I like that 30-70. If I need something a little bit more risk adverse and I need a little more balance in my portfolio, well, then maybe I'm at these 40, 50% levels of stocks and bonds versus, and then I can even put in more cash and things to help reduce risk too. You can put in other assets as well, but this is simple cash and bonds that they have here, and you can look at these numbers and kind of scroll through these numbers. And then if I'm like, no, I want to grow my funds, I want to grow my money, that's why I'm investing in stocks, hey, that's why I'm taking your course. Well, terrific. Glad you did. So growth-wise, then you might want to be looking at these 70, 30, 80, 20s. 100%, you better have an iron stomach if you want to do the 100%. And certainly make sure you're diversified. Don't put 100% in 2 stocks. Make sure you get some nice exchange trade funds or mutual funds, or at least hold a nice portfolio of 30 stocks or so to help give you some give you at least some diversity if you want to go that route. That's the nice thing with like a mutual fund. You can get hundreds of stocks by basically buying one fund as far as that diversity. But growth is all about more risk, more volatility, but that better long-term growth. So once again, you can get this in yourself, print it out from the Vanguard Group, search model portfolio allocations. And over time, and as you get used to your investing, as you or become more experienced with an investor, you might shift between these different portfolio allocations, and that's good as part of rebalancing. But right here, my whole goal with this was to give you an idea of what might look like in terms of portfolio, and I really hope this helps you as far as when you start deciding how much stocks you want to buy, and then in there we start getting down into more detail, like what types of stocks to buy: dividend stocks, growth stocks, international, large cap, small cap, all these different things we can look at to build the subparts of this portfolio. But from the macro level, at least this gets you a start, and there's other tools out there, but I hope this gives you a start and gets you on the right track and gets you a feel for what your portfolio might look like now and in the future. Well, as you know, it's important to diversify your overall investment holdings to balance risk versus reward, or risk versus return. And so that's where you have different asset classes like stocks and bonds and cash and precious metals, maybe like gold and silver, and whatever else you might have invested in, the real estate, whatever it might be. You have a variety of asset classes that you're investing in. Now, within each of those asset classes, you want to have a variety of assets within that. Maybe you have some bond holdings. You want to have maybe short-term bonds and medium-term and long-term bonds, and maybe government bonds versus corporate bonds. There's a whole bunch of things you can do with just bonds. But this is a stock investing course, so let's talk about stock. So not only is it important to have a diversified portfolio of these different asset classes, stocks, cash, bonds, etc., you want to diversify your stock holdings too, whether they're individual stocks or mutual funds or index mutual funds or exchange traded funds, whatever it might be of your stock-based holdings, your public stock-based holdings. You want to diversify those as well. And there's a variety of ways to do that. Really three big ways that we're going to look at to really diversify. And then within those classes, you can hold a whole bunch of different types of securities or equities or stocks, all mean the same thing, so that you can have diversification within each of the categories. But to start, the 3 big things you want to look at is how am I diversification, what types of things do I hold in terms of size, style, and sector. And so what we mean by size is probably what you think. How big is the company? Is it a large company versus a small company? And in the next lessons, we'll look at the differences between like a small cap, mid cap, and large cap, or capitalization, a small capitalization stock versus a mid or large capitalization stock. And what does that mean, and how do we evaluate stocks based on their size? Next, we want to look at also how do we evaluate stocks based on maybe their style or style factors, like where do they fit? You've probably heard the terms like growth and income, or maybe in value, right? So if it's a growth stock, maybe it's a high technology stock that's on fire and they're growing like crazy. Well, that's a growth stock versus maybe a 100-year-old company that pays a great dividend. That might be a value or more of an income type stock. And where does value come in as far as, is it overvalued or undervalued? And is there a way to have a value-based strategy? And there is. Also, maybe where they're based, domestically or international, is another way of style and breaking up the style, whether it's a stock, a mutual fund, ETF, whatever it might be. And lastly, a sector. What sector does that stock, is it related to? Now think of it as like an industry, right? So if you're looking at ExxonMobil, a big natural or oil and gas type company, well, they're in the energy sector. That's what they do. Versus, let's say, Coke and Pepsi, which are beverage makers. They do other things too. That's the thing where it gets a little weird sometimes. You have to dig a little bit, but they're primarily a beverage maker of soda drinks or carbonated beverages. Where I come from, we actually call them pop. So every culture might have a different way you might call Coca-Cola or Pepsi. But they're all within sectors. If you have a bank, that's in the financial sector. And then even within the financial sector, it can break down from there. Or the healthcare sector, you can break it down into subsectors from that. So for example, let's say healthcare, you have healthcare as an overall sector, but then within that sector, you might have things like hospitals is a subsector or a subunit. And then you might have pharmaceuticals, people who make drugs. Drug companies are pharmaceuticals. You have nutraceuticals, which is like nutrient type things and base things around that, or medical devices such as heart stents and valves and things like that that are more of a device to treat people versus, let's say, a pill or a drug like a pharmaceutical company might make. Or how do you do insurance? Maybe you have managed care or different types of healthcare that might fall under that overall umbrella of healthcare. So, and then there's also things like biotechnology. Or biotechnology stocks and things of that, like Amgen. So there's a lot, even within a sector, that you have all these different subsectors. So if you were to say to somebody, yeah, I'm invested in healthcare stocks, the person should say to you, that's great. Which sector of healthcare are you in? And then you can maybe talk about individual stocks. And some individual stocks might play in lots of sectors. Johnson & Johnson, they do medical devices, but they also do a lot of things in medical around things in the operating room and some things around that. And you probably know Johnson & Johnson from Band-Aids and things that you can buy as a consumer. They make those. So it's very interesting as far as how you can break down stocks. So that's one way to diversify your holdings, is looking at these categories. And we're going to really explore that more in great detail next in the upcoming lessons. But think about, if all I own is large cap stocks, well, I might be at more risk than if I had a mixture of stocks that might be smaller, medium versus domestic or international. And maybe I need a variety of sectors too, so I'm not all in energy or all in healthcare. And that's the way you want to diversify your stock holdings as a subset of your overall holdings. So think your overall holdings, stocks, bonds, cash. You have your stock section, diversifying around size, style, and sector. And that's what we're going to look at now. Okay, you've got an understanding of stocks and how they work and how markets work. Now you want to go buy some. Now it's time, the fun part, where you get to go pick them. And there's a lot of different ways you can go to pick stocks. Some people might say, I like the look of the company's logo or the colors that are in the logo, or I went and saw a Disney movie and I thought it was a great movie, so I'm going to buy Walt Disney stock, for example. Well, that's okay. Not as expertise behind it, but a lot of people buy it that way, or they just regular buy their own company stock, which if you do too much can be a little risky, by the way. So be aware of that. But mostly folks are looking at a little bit more analysis, a little bit more data than that. And really the analysis comes down to two parts, qualitative information and quantitative information, or data that's become information. Usable data is information as we know it. So you're looking at qualitative and quantitative. And what's the difference? Well, qualitative is not numeric. It's kind of those non-number type ways, and we'll look at that in a second here. And then quantitative is the numbers. It's the hard cold numbers. So let's take a quick moment to look at these two things before we start getting into things like ratios and really in-depth around different ways that you can evaluate companies. So first off, quantitative, as I mentioned, is the hard cold numbers, right? It's not opinion or anything like that. It's like, here's the numbers. Here's what our sales numbers are. Here's what our earnings numbers are. Here's the stock price. These are all numerically based things. So that's the quantitative aspect. And you're looking at financial results. And from those financial results, you're developing or using, there's very many well-established ratios and things that will highlight us for some of the key ratios out there to evaluate companies versus one another. Whenever you're evaluating companies, and I'll say this many times over, so bear with me on this, but it's really important to compare a company within its own industry against its peers. It's hard to compare Google, a high-tech company, versus ExxonMobil, a well-established income dividend-paying oil company. You can. They're both large companies. They're both large company stocks. There's aspects of it, but there's really kind of different industries. So you want to compare maybe Google versus Yahoo versus maybe ExxonMobil as a comparison. So financial ratios, you get those from different sources. And when we get into the ratio part, we'll talk about exactly where to find them or how to get them. And most of them are publicly domain anyway, so you never really need to calculate them. But it's important to understand where they come from. And they typically come from the business financial statements. And those are, the balance sheet, looking at the assets and liabilities of an organization. What do they own? What are their assets? Buildings, fixed goods, real estate. What are their liabilities? What do they owe in debt, or who they got to pay stuff to? So their liabilities, you subtract those two, you got what are your income or your net value of your company, what's your retained earnings. So if you're an accountant, you would get all that. But the idea is you're a moment of time as far as looking at your balance sheet. Then you have the income statement, which is showing the inflows of money and where that goes from the income statement. And then the statement of cash flows is really analyzing cash and the inflow and outflow cash and how's your cash position changing. Those three documents that are required to be published out there are very, very important, where a lot of these ratios come from. But those are the cold hard numbers. That's just like numerically, I'm not invested in it because I like the latest Disney movie. I'm just looking at what is the numbers on. Now, qualitative, we compare that now to qualitative, that is not numeric. That's the quantitative part. So a lot of times with qualitative, you're using things like logic, for example, or maybe things like your gut or emotion or your knowledge about a particular industry or company. I mean, sometimes if you work within a company and you've worked in that company for many years and you worked in a particular industry, you'll know that industry well. That doesn't mean you're an expert as far as buying stocks in an industry, by the way. You still want to do your due diligence on it, but you'll understand that industry and what's working and not working in an industry better than somebody who maybe has not worked in that industry. For example, if I'm investing in, let's say, healthcare stocks, and somebody's a doctor that I'm comparing to, a doctor is going to know more about healthcare and what's working, what's not working, how managed care works, all that stuff better than maybe I would as far as knowing the industry. Now, I might be a better investor, though, because I know how to use analysis and quantitative stuff and how to build a better portfolio. But at the beginning, that person will know that industry from a qualitative standpoint. You also want to look at from a qualitative standpoint is what's going on in the wide world. What are these demographics? What are trends? What is happening out there? So if you're interested, as a good example is healthcare, understand that the population is aging, that we're having more longer lifespans, and there's more opportunities for companies who are in that healthcare field with their clients. Basically, in many cases, they're going to live longer. That means they can buy their products longer. Just that nature itself can be really good. What about for millennial generation? What are they buying? What types of things are they buying? The investment in technology and understanding technology, and that's maybe where technology stocks might target that particular market. What's happening from a global aspect? And we live in a very global, interconnected world. I mean, I'm very blessed to have tens of thousands of people in my courses here, and I've got in my online courses, and I got folks from all over the world. I have folks from over 141 different companies that watch my videos, my training videos. And I'm very grateful and blessed, and thank you so much for doing that. But think about how the world has changed, that I can do this over the internet and offer this type of training and education where, even a decade ago, it just really wouldn't work well. And decades before that, it's like, forget it. You could just work in your local market, maybe go around and give speeches and give live training. Now we can reach people through the internet. So there's a change and a trend within the world. So what does that mean for maybe you're interested in investing in companies that do online training? For all I know, that might be an opportunity around that. So your sources for that, from qualitative information, is coming from what you know about the industry, from news, management statements that might be out there. So a lot of times when they release their income statement or the balance sheet, they might have a conference call or something where they're talking to investors or the investment expert community, and they're talking about future things that are going to happen. That might not be numerically based, but just saying, hey, we're looking to invest in this new market, or we're going to expand here, or maybe we're a retailer and we're going to close stores. So what does that mean for our stock? Or we're going to open stores. What does that mean? Or we're going to lay off people. We're going to hire people. So looking at these management statements coming out can impact a stock. And then also what some of these research analysts who are on these conference calls are listening to, what are they saying out there too as well? I mean, anything could change. There's a lot of information out there, but you have folks that are dedicated to researching stocks, let's say in a particular sector or field, and they give out statements and they talk about stocks around there too. So that could be part of your qualitative information. Warren Buffett and other well-known investors, especially Buffett, really talks a lot about understanding the company and the industry, and that you really understand that before you invest in it. And I know I've had some experience with that too. I've had better success with companies I've either done business with, or I really understand more so than maybe companies where it sounded good, it sounds like a great technology, and I'm just taking a chance on it. And sometimes it's worked and sometimes it hasn't. But I know in my own personal success, the more I can understand the company, the more I can understand the industry, the more I can understand that qualitative aspect, and then bring in the quantitative aspect to back up my decision making or make me make better decisions, that makes me a much, much better investor than just following some news or what's the hot stock now. That can always usually lead to trouble, because once there's a hot stock out there, people know about it and the price has been driven up, and maybe it'll go up, but maybe it won't. So qualitative information is not numeric. It's kind of that overall information that you're gathering, and then use it with the quantitative stuff from the balance sheets, the income statements, and the statements of cash flows, and those financial numbers together to make your choices. So now we're going to take a look at some of these really important ratios. And there's some real key ones. There's hundreds and thousands of ratios out there. Well, maybe not hundreds of thousands, but there's lots of ratios out there. But there's a few financial ratios that are really key ones, particularly depending on what you're looking to invest in, from growth stocks to maybe dividend or income paying stocks. So let's take a look at those. Before we look at individual ratios, these top ratios to look at from a financial perspective, just a couple real quick things to keep in mind whenever you're evaluating a company using really any ratio. First off, where do ratios come from? Well, the balance sheet, the income statement, and the cash flow statement. That's where their original numbers and things come from, and they then come from the operations of the business. So when they have sales, for example, that's all aggregated, and then that ends up in, let's say, like an income statement as revenue. So it's from the operations of the organization, but it's balance sheet, income statement, and cash flow statement is where you're going to see where these ratios come from. And one thing that's really, really, really important is to compare ratios within the same industry, or comparing companies versus one another in the same industry versus outside their industry. Because a company might look great compared to the broader market, but within its industry, it might not be as great a performer. Or there might be things that, like, technology stocks or something like that might have high price to earnings or high price ratios because they're very big growth stocks, and which could be a great thing, but you might shy away from them because you look at the broader market and see lower price to earning stocks or lower PE ratios and say, wow, those seem like safer bets. Well, they may or may not be. So it all depends on that industry. So do compare within the industry. Another couple key real important things is some ratios are more important than others depending on the industry itself. So if you think about it, not all ratios are the same. They're all the same as far as calculation, but some industries reward, or it's more impactful for certain ratios than others. Let me give you an example here to kind of drive that home. Inventory turn ratio, which is how fast are you selling your products and goods, how fast are you turning that inventory. The faster you can turn your inventory, the better efficiencies you have, the better profitability you have. So inventory turn is an important ratio. It's a very, very important ratio for like retail companies. Because you think about it, a retailer has a lot of inventory, right? You go to a big store and they have lots of inventory. Let's say it's a clothing retailer. They have lots of different styles of clothing. Maybe it's different seasonality of clothing, winter, spring, summer, fall. And so they got a lot of different stuff just for a clothing retailer, let alone somebody who does hard goods as well. So how fast they turn that inventory is very important when you're evaluating a retail stock. It might be less important when you look at something that doesn't carry a lot of inventory, maybe like a media company, for example. It has assets, yeah, but it has digital assets, but it doesn't have those hard goods sitting on a shelf that's got to be sold, or they're also going to be marked down as a loss or sold on clearance because summer has ended, winter is coming, and now people are buying parkas and they're not buying shorts or things for summer, swimwear, for example. So inventory turn is a real important retail, or wouldn't be in other industries. So same thing with any of these ratios. Understand which ones are more important within certain industries. Also, some ratios are more important by the type of stock than others as well. Some are important across lots of different things. The only price to earnings is important, but it's a way to value growth and value stocks, for example. But if you're looking at, let's say, dividend stocks, dividend yield or dividend payout ratio, those things that are related specifically to dividends, well, those are life or death for you. You really are wanting to buy a company that's got a good dividend yield that'll continue to pay it. Well, that's very, very important. And you want to really compare companies and really analyze that dividend payout and that dividend yield versus, let's say, a technology firm or a health firm or somewhere that pays no dividend at all. Like, how can you compare a company that doesn't pay a dividend? Dividend yield doesn't mean anything anyways. It's no big deal. Or if you look at, we'll use technology again. There's some technology companies like Microsoft that pay a dividend, but are you going to buy Microsoft because it just pays a dividend? Well, you might, but maybe you want to go with more growth stocks in technology, for example. Either way, for dividend stocks, you're looking, that ratio is more important than maybe even like a retailer with inventory turn. Maybe it's a retailer that pays a dividend and you might be more concerned about dividend yield. So the type of stock, whether it's a growth or an income type stock, can make a difference as well. And understand there's lots of ratios out there. There's hundreds of ratios, and I'm going to give you some here that are the real key ones, the ones that you see across the different categories, from liquidity to all sorts of things, evaluation. If you do these ratios, you're going to be fine. At least you'll get a starting point. Many people don't use ratios at all, but if you're going to use ratios, these are the key ones that are used over and over again. If you try to analyze a company by like 100 different ratios versus 10 other companies, that's just going to take a lot of time and might even lead to paralysis by analysis where you don't make any decisions at all. Or maybe you start looking at some ratios that aren't important and thinking they're important. That can cause some, behavioral issues or cause some problems as far as investing because you looked at the wrong ratio that wasn't important because it was the number 30th ranked ratio for, that industry, so to speak. So when you're looking at ratios, here's some key ones that we're going to look at now that if you do these, they'll really give you a great start and really understand these well when you're starting off and really starting to compare companies. And if you want to go beyond that, feel free. And using your qualitative and your quantitative analysis. Okay, so maybe you've learned a lot about investing in stocks and maybe picked out some stocks and things are good. And it's like, okay, well, that's great, but how do I actually go about buying them? What are the mechanics involved of actually buying the stock? It's like, I want to buy this stock, or I want to buy this stock mutual fund or exchange traded fund. How do I do it? Where do I go? Who helps me with such things? And that's where we're going to talk about here in this particular section, where we review all the different types of services that are out there on how you can buy and sell or trade stocks. We're going to look at the different types from full service brokers or brokerage houses, which is the traditional kind of, you think about buying stocks, you go through a broker houses, but now there's a lot of different options out there. You have discount brokers or online brokers where you can get a lot more discounts involved with your buying and selling of stocks. There's online robotic or online robo financial planners where they're in between a stockbroker and a full service financial planner that gives you some advice or at least some ideas around building a portfolio. There's financial planners who not only help you with stocks, but they might help you with bonds and cash and other things and a total investment picture and all other things such as insurance and things a financial planner would be involved with. You can even buy, in some cases, a few cases, buy stock directly from a company. And we'll talk about how you can do that and which companies might offer such services. So I'll give you examples of well-known companies in each of these areas and different options that you have in there. I'm not recommending anybody in particular. It all depends on your particular need. You might like to use a financial planner versus, let's say, a stockbroker or versus an online type solution. They're all a little different, but you're going to be able to understand from this section what are the advantages and disadvantages of each of these types, and then you can decide, well, what's the best fit for me? Also understand the information changes frequently, especially with online investing and some of these robo investors and others where they might change things frequently, so be aware of that and always keep on top of that and do your due diligence as far as what works for you. If you feel more comfortable with investing on your own, you've learned some stuff in the course, you're like, I can handle this on my own, well then maybe like an online discount broker might be a way to go for you, or even a robo financial planner. If you're somebody who says, no, I need a little bit more help and want some help around my whole financial picture, just not investing in stocks, but in bonds and cash and insurance and a lot of other things, well maybe a financial planner would be the best choice for you. Either way, it's about you and your choice, but here we're going to give you the information on each of these things so you can make a good choice. So with that, let's go ahead and get started in this section and learn about different ways that you can go about buying stocks.